Good afternoon, everybody. My name's Gould, and I'm delighted to be able to welcome you to what I'm sure will be a very lively discussion on the present state of the financial relationship, focused very much on that between the MGAs and the capacity providers. In particular, we're going to be focused on the merits of commission and fees and their influence and interaction with loss ratio, reinsurance and expenses costs in delivering mutual profitability, and of course asking if that is sustainable. Now, you should have access to the app, so if you've got any questions or comments you want to push through, please do so while we're talking. We've only got half an hour, but I shall be looking at this iPad all the time, and if I don't touch it, it will work, and I'll try and pick out some questions from the audience. We do have a very highly experienced panel for you today with representatives from all of those in the value chain, or to put it crudely, all those with a nose in the trough. So without further ado, please welcome our insurer, Jon Walker, CEO of AXA Commercial, our MGA, Tim Smyth, CEO of UK General, and our broker, Stuart Reid, Chairman of Partners And. Now, Jon, as an insurer, I'd like to start with you. You're a large insurer, so how do you balance the need to cover your fixed cost base and fairly reward your MGAs?
Good. Good afternoon, everyone, and thanks for such an easy question to get us started straight into expenses. So we look at expenses in lots of different ways and different layers, and aim to get to quite a high level of granularity when we look at each MGA, each scheme arrangement that we come away. So we financially model everything that we do, and I guess if I would describe the different expense layers that we have. So at AXA Commercial, we're obviously part of AXA Group, and being part of AXA Group means there are costs that get allocated to the business. At group level, AXA UK and Ireland level, and then there's costs within the business that are directly within our control. And I think when we look at expenses, it's important for me that we don't just think about the numbers and look at it in a very binary way, because the expenses are also accessing things that add value. So if I look at it from an AXA Group perspective, one of the things we all get from AXA Group is the value of the brand, the value of security, and financial security and longevity, and that I think has real value attached to it. If I look at it at UK and I level, what do we get there? We get IT systems, we get governance, we get regulatory advice, and then when we bring it down to the business level, we've obviously got the frontline teams that many people in this room will work with. So it's when we get into the business that directly controlled expenses has a higher degree of variability to it, I would say. So in AXA, we have a dedicated function, a dedicated team that look after our MGA and scheme arrangements. So we're really, really clear on what the expenses are associated with that team. And so what we're able to do is look at expenses more broadly and say we also have a branch network. Our branch network trades in the open market space. They're not adding a huge amount of value to what we do from an MGA perspective, so we don't allocate costs. So we're able to allocate those costs at a granular level and relative to what each MGA does, which business line they're in, etc., etc. I know. Underlying the question is how do you reduce your expense base? I'm sure that would be an ask that many people would have, and we'll perhaps get back to that later. But I think it's important for me to say we recognise we're in a really competitive market. So it's not in our interest to load our expenses, because actually that will make us least competitive and least attractive, and therefore you will choose to engage with another capacity provider and take your business elsewhere potentially. So we're very mindful that we can't magic expenses away. I can put a different number on a page, but our expenses are our expenses, and they bring value to the relationship and to the end customer. And I think we should reflect that. And in that modelling, we do. Yes, we are looking to make a margin. That's a relatively small margin, actually. And obviously we have to apportion the commission levels that are required and how that sits across the chain, and ultimately satisfy ourselves that for the product and the proposition the client's buying into, they are getting the value that everyone would expect them to get. So we've got to keep one eye on that as well. But my ask, I think, would be, when you look at expenses, look behind that and think about the value that you are buying, because typically, not always, but typically you kind of get what you pay for.
Okay, thank you, Jon. Tim, I'm going to bring you in there. I mean, Jon's talked about a high level of granularity, which I interpret as transparency. But what do you think of the existing financial models from an MGA's perspective? I mean, is there consistency in how insurers calculate or justify their expenses allocation? And do some insurers, and we're not talking about just AXA here, also add in reinsurance costs even though their book won't attract any cover?
Thanks, and good to see you, everyone. As far as UK General are concerned, we're a personal lines MGA. We delegate authority. We run and have to run a very competitive distribution chain, because that's the business that we're in. And I think Jon gave a very detailed answer as to where AXA's position is, and I think in fairness to AXA, I don't spend a long time studying these, I think their expense ratio is probably sub 10. Relative to other insurers is probably better value than a lot. Having said that, I think for full-blown MGAs that have full service, which includes pricing, product, reserving, there's a lot of things that we do within our business that we don't feel should be necessarily replicated in a model like yours. So I think it's about working with insurers that are willing to have a very transparent discussion and say, look, we have an obligation here when we serve our brokers and our direct clients to give the best possible product at the best possible price. So we can't do that unless we're all very transparent with each other. And the insurers that we've tended to work with tend to be ones that don't have their own retail distribution. They tend to have strong balance sheets. They might not have the AXA brand, but I don't think that's something necessarily that we need in our business. Others may want to put a price on that. I don't really want to feel that we're going to pay for that. And I think it's important, I guess, to have that very granular discussion around, well, who's paying for what, and making sure that we can, structure something that makes sense at the end of the day. Now, the discussions that we have with our capacity providers, we in fact buy our own reinsurance program, so we have total visibility of that. I wouldn't accept the cost of reinsurance on protecting something that wasn't impacting our business. And I think it's up to the relationship that you have with your carrier to say, well, this is what we want from you: strong balance sheet, good, strong regulatory position, and we want you to trust what we're doing here and work with us, not over us. We're not trying to double up on what we're doing here. So yeah, that's where it would be.
What tends to happen when you push back then?
To be fair, the insurers that we have at the moment are, as I say, people who are really more about balance sheet provision, and they understand their expense ratio is extremely low relative to what we're doing. We're very transparent with them where we're spending our money. This is quite an emotive subject, and one that I know many of my colleagues here in the room have spent many, many years arm wrestling over many, many years as to what the right the apportionment of the commission is across the piece. But to me, the most successful relationships have always been built on that trust and transparency model.
Okay, thank you, Stuart. I want to bring you in here. Obviously, brokers get a commission, but as a broker, you're the party in the chain that is supposed to be the customer champion. I mean, do you have a moral and regulatory responsibility to push back if you believe the financial relationship between the MGA and the capacity provider in particular is just serving to push up end customer prices? In other words, does the FCA's recent fair value statements mean that commission payments are likely to become increasingly under the microscope and need to be justified?
Well, thank you for that, and hello everyone. Well, I think there's two parts to that, isn't there? If MGAs are arguing with capacity providers about how much of the pie they get, within reason, if that doesn't affect prices, knock yourselves out, frankly. If we're talking about fair value, that's a completely different subject. And without getting sort of too carried away, because there's still stuff to come out about that, the inference is at the moment is that an insurer, and I guess in certain cases MGAs, will have to ensure that the product that they sell provides fair value to the end customer. Us in the broking world view that with a little bit of trepidation, because what that means is that an insurer or an MGA that's creating their own policy, if I can put it that way, will need to know what the final price is. And that is a very, very big change. So as regards that relationship between MGA and capacity provider and who gets what and what proportion and how much of the profit, within reason, that's not our concern if prices remain level. But what is of our concern is what are the ramifications of what could be coming down the road regarding the FCA rules regarding fair value.
Okay, John, Tim, do you got any comments on that aspect?
No, it's a big responsibility for us, as a manufacturer of products, and like John, where we've in the past had quite long distribution chains, maybe had people in there that weren't even regulated businesses or indeed not even insurance businesses, but selling policies as ancillary covers. That's a big change for our business, is having that line of sight across pricing all the way down, and who's taking what and what are they delivering. But it is a big challenge, but one that we'll work through with key partners and regulated partners as well.
Yeah, and just to build on that, so I think Stuart's interpretation is exactly right. The regulator definitely expects the manufacturer to demonstrate its understanding of the value of the product and therefore ultimately the end price to the customer, and that is going to take some working through, because value in itself is quite a subjective thing. Higher or lower levels of commission doesn't necessarily equal better or worse value. It's what is the customer actually getting relative to the things that are of most value to them, and sometimes getting the things that are of most value cost more money to provide. So it's definitely a challenge. It's definitely a challenge for the industry. But I agree with Tim's point, which is at the heart of all of this debate is the value of strong partnerships and being open and honest with one another and working things through together. And where I've personally seen challenges with MGAs or DA or schemes arrangements that haven't gone to plan, it's because something hasn't been quite right in the partnership. So we can talk about all the financials and the specifics, but actually wrapped around all of that is don't underestimate the power of partnership and relationships. I still think as an industry we are a relationship-led and based model, and long may that continue.
Okay, obviously as long as that relationship is fair value for the customer.
Absolutely, yeah.
Just to remind you, you can put a question to our panel by using the app. It will ping up right in front of me, and as long as there's no swear words, I will probably ask it. Tim, as I understand it, there has been talk today about lack of capacity, but some MGAs have got very profitable, good standard books, and they really want to get a bigger slice of the pie, but due to the existing relationships, there's a real lack of flexibility about how they can do that. I mean, we've seen people like CFC set up their own syndicates, and there's also cheaper alternative capacity coming in. I mean, do you think we'll see more of this happening?
Yeah, undoubtedly. I think just on the last point, dealing with that first, cheaper capacity, we need to make sure it's good quality. I think, we've all heard and seen the stories of car crash security that has folded very, very quickly. Everyone's been calling out for not rated or a very different jurisdiction. So you need to be very, very careful that doesn't blight our industry by using poor quality capacity. Having said that, you see what Lloyd's is doing with the Syndicate in the Box initiative, and I think you were referring there to CFC. Starting their own syndicate. John Neal's come out and said this is very much a strategy for Lloyd's to say, come along. I think the size of it is probably in the 50 to 100 million, so for a lot of MGAs of size, that's not going to be the panacea that deals with it. It might be a way of aligning yourself to some form of risk. But we've, for many years, participated either via captive or via reinsurance behind a carrier. I think it's good to be in a place where you've got the balance sheet strength that you can align yourself to the carrier, because ultimately they make money, we make money as well. And I think that commonality of interest is hugely important, subject to the terms being correct. But I think there's everywhere you read, there's a wall of money out there. You know, everyone wants to be in insurance, whether it's lending it to Stuart to go and buy lots of businesses, or whether it's to invest in new startups like Convex. You know, there's billions and billions of investment capital available in our industry. I think there's a huge opportunity for us here, particularly as we innovate and we use technology to offer better value, to be more joined up, to be able to recognise risk through the transaction chain much, much quicker than is happening at the moment. And I think all of that use of technology, data, will give people confidence that actually putting funds that aren't necessarily insurer capital, but into some form of risk bearing, is actually a really attractive alternative asset class that might not correlate with putting it on, you know, NASDAQ or, you know, investing in the next .com. You know, I think so. There's an attractive asset there in terms of participating or backing MGAs that know their subject matter, have a really deep experience and expertise, and have good use of data. I think absolutely we'll go more that way.
Okay, I mean, Jon, I was going to come back to you in terms of the desire by successful MGAs to have a bigger slice of the pie. I mean, how do you think insurers will respond? Are there things you could do differently? Can it be a more equitable relationship where it tips over into high profit, where you can have a more equal distribution of that profit?
Yeah, I mean, it's an interesting question, because implied in the question is that the current share of margin is inequitable. And if I was to look at our results over the last 10 years and look at our margins versus the rest of the chain, I would suggest we probably haven't taken the lion's share of it. However, in the spirit of answering, and that is an important context actually, because we would always consider flexible ways of looking at if there is consistency of results. For me, it's about making sure the share of that is calculated on the basis of where the work and the value is added, where the risk is taken, and it's proportionate. I think ultimately one of the things that insurers can practically do is find ways to manage their expense base more efficiently, make it work harder. So, you know, we are looking very long and hard at lots of efficiency and effectiveness measures without harming the service that ultimately gets provided. So technology, use of automation, removing non-value add to genuinely bring the expense ratio down where it's possible to do so. As I said earlier, we'll flex based on what the opportunity is and where we think we can get to. You know, things like profit shares, they're quite, you know, that's quite a well-trodden path. Again, we just need to be mindful moving forward that we do that in a way that doesn't cause any conflict. So, you know, difficult to have claims delegation and a profit share without being conflicted, I would suggest. So there's lots of things that we can and do actually on a regular basis in order to come up with a model that works. Increasingly, you just have to be very thoughtful about how you make that work in practice, and that it does deliver fair value and it does hold up against any regulatory scrutiny. But yeah, in terms of flexibility of approach, we will always listen. You know, we have our own governance processes, we have our own shareholders that will have their view, and it's just working within that framework, working with people like Tim and Stuart and others, and coming up with something that does feel equitable across the chain.
Yeah, I mean, you mentioned flexibility, being able to do what you think is right. Do you feel threatened at all by the prospect of this alternative capacity? And are insurers in danger of doing what's happened sometimes in the past, of perhaps being a bit complacent about the way things are? They've always been done this way. Yeah. We don't need to change. It's
a great question. So we're definitely not complacent. That much I would say. And the other thing I would say is if people are looking for cheaper capacity, they will find it. That is never going to be an issue. But to Tim's point, you get what you pay for. So be very thoughtful about what you are, what you're stepping into, and where the value is. And I think we have to look at this from a customer perspective and think about the value adds and think about what that means in terms of capacity providers. So I don't think comparing an AXA to, and I won't name names, but there have been some failed overseas capacity providers. If you were to compare AXA to one of those, I would say no, that's not a fair comparison, and I wouldn't be unduly concerned about that comparison. But it's a competitive marketplace, and you all have choices, and that isn't lost on us. So we do have to make sure we keep our expense base under control. We flex where it's appropriate to flex. We do that in a very transparent way, and never get complacent, because in our industry that bites you pretty quickly. But equally, you've got to compare apples with apples, and I think sometimes we have these conversations and the comparison isn't equitable, I would say.
Yeah, so Stuart, I want to bring you in there really. I mean, obviously the frictional costs related to the distribution chain of insurance is extremely expensive, and that includes your commission as well, obviously adding to that. I mean, do you see there being a better way or any change afoot?
No, I mean, our industry needs to be innovative, and there are different ways of distributing the product. I remember I used to run a business called Bluefin that was owned by AXA, and I remember going in there and saying, well, what's your overhead if you're underwriting it yourself? And that was 16 points at the time. And what's your overhead if you go online? And it was 16 points, 16 points for that as well. And I think it's interesting to hear that you're saying that you're looking at your overhead. Certainly in the businesses that we acquire, we're looking at an average commission base of 17 to 22.5%, and I think that's probably equitable for the work that's done. It's always very difficult to work out fair value on a policy that may claim or may not claim, and therefore, how do you term the policy? There are brokers out there that do things slightly different to the businesses that I'm involved in. Administration fees, commission and fees, premium financing, and without wishing to keep being a broken record and come back to the same topic, I think that fair value issue, that fair value policy that the FCA are putting out, I think it may address some of those issues. But I think on the whole, a broker earns a decent commission, but I don't think on the whole, most of the brokers out there earn too much.
Okay, I'm sure some might disagree, but we'll move on.
On the whole.
We're technically out of time, but I'm going to ask one last question, which is two questions in one. So looking forwards and to sum up, is there a better way, a more equitable way, which will mean better prices for customers and a fairer return to all those in the chain? And the additional part of the question, if you can remember it, if there is one action or takeaway that you would like the MGAA to take on board after this debate and look to progress, what would that be? And I'm just going to start in a random way with Tim at the end.
Lovely. Thank you. Look, we've got a duty of care amongst all of us, whether we're broker, MGA or insurer, to just take out the friction out of what we do. It staggers me that even now, here we are in 2021, and roughly speaking, 35 to 40% of all the premium that a customer pays doesn't go back to that customer. So we have friction in our industry of 40%. When I think I compare that with lots of other areas like investment and what have you, how they've moved that goalpost so hugely. Before it was 2-3%. Now you've got lots of funds working at 0.3, 0.4%. So they've moved sort of 60-70% the other way. So I think the challenge to our industry is, how does Stuart operate on 15%, I'm not saying, but make the same level of margin? How does Jon reduce his expense margin that he would put on us, and how do we deliver the same? And I think the only way that's going to happen is by a proper joined-up approach that makes sure that the customer's getting what he's getting at the end of the day, paying a fair price. We're all aware of that, but that we're not duplicating it. And the other thing for me is the time taken. I mean, I'm sure I'm not the only one, but I get massively, I'm a fairly impatient sort of individual. And I think, if it goes back through my career, the time taken now to negotiate any new deal, and I think all of you would agree with this, you'd be lucky to get a new arrangement away in 9-10 months, probably a year or more. And all of that's got to be paid for. We're all paying staff to work really hard and put these presentations together. Ultimately, who's going to pay for that? The customer's going to pay for it. So what is it that we need to do? We need to take a lot of that friction out. And that's a collective responsibility. I think we've got to be fair, we've got to be apportioned across the piece. But as an industry, with all this new technology coming in, if you look at the last couple of years, our overall money that we're taking out of the industry in expenses and in acquisition costs is going up, not down. And that just seems to be ridiculous to me. We should be driving it down because of the use of technology, not increasing it. So what's going wrong?
Okay, and just to remind you, the final question was, do you think there's anything the MGAA could do to help address this? Bring people together?
Yeah, I mean, definitely, and I think Mike's clearly very experienced in this area, and so are his colleagues, in terms of making sure that people have a greater understanding of what everyone's doing in the chain, how we can operate better. The MGA world is here to stay. It's growing. It's fantastic. I'm very passionate about it. I think it serves a very good purpose in the insurance ecosystem. We now need to make sure that we're all delivering value for our end users.
Okay, and Stuart now, as the customer champion, what's
Yeah,
your
I'll keep it short, but I couldn't agree more. I think technology is going to affect every single part of the industry that we're in. It's a line that was said at a previous talk here this afternoon, so I'll steal it, but it is true. And I think technology will drive costs down and it will speed efficiencies up. It won't save as much in all areas as other areas, but it will drive change throughout the industry. What can the MGA do? Well, I think Mike is an excellent steward in charge of the MGAA. I've known him for a long, long time, and I think round peg, round hole. But what I suppose a carrying call for me is I do get involved in some insurtech business. It's not a question of who earns what, it's a question of where the hell is the capacity. We've got a lot of innovative firms out there who are doing things very differently. And I won't embarrass any of them by mentioning their names. But it is really, really difficult to get capacity. We're supposed to be the most innovative insurance market in the world, and I think we probably are. But finding that capacity for some of those small insurtechs is very, very difficult. So anything that could be done to help in that regard would be much appreciated.
And finally, Jon, I'll give you the final word.
Yeah, and I'm really conscious of time, so I agree with my esteemed colleagues on the panel. There's definitely a big role. There's definitely a big role for technology. There's definitely a big role for partnership. We talk a lot about partnership in the industry. I still think we've got a lot of room for improvement in terms of demonstrating that what we say we're serious about. I think there's some fantastic examples. We've got some fantastic examples in AXA, but I think working in partnership is going to be incredibly important. And in terms of the role of the MGAA, I think bringing people together is one thing. I think the other thing is us thinking through how can we have collectively a different conversation with the regulator. Because a lot of the process, so if I think about Tim's point on how long it takes to get a deal signed off, a lot of that, certainly from my perspective, is going through the governance process, which has got increasingly more challenging to navigate our way through. And some of that I get, and some of it I think is slightly ill-conceived views from the regulator's interpretation. And I think what we should do is think about how do we have a more proactive conversation with the regulator to demonstrate that we can deliver the value, which ultimately is what they're looking to get. But there are other ways and other models to get to that value that take a lot of the frictional cost and duplication out.
Okay, thank you ever so much. We are out of time now, and I think to sum it up really, I'm going to quote Joe Strummer, a hero of mine, who said the future is unwritten. With that, I'd like to thank all of our panellists for taking part. Thank you.
Thank you.